Can you really make income every week selling puts on big household names on stocks under 20 bucks? Let's do the math. I'm going to walk through two in this video. One barely pays and the other actually might. Welcome to the next episode in our series where I walk through stocks under 20 bucks for people trading smaller sized accounts. In this video, I'm going to break things down slow and be honest, because not every stock under 20 bucks is worth trading just because it's cheap. I'm going to go through two massive, well-known companies, Ford and American Airlines. Now, everybody knows both these companies, but the options premium between the two is very, very different. Now, before we jump right in, do me a favor, subscribe to this channel. I'm putting up tons of videos on options trading, and you don't want to miss one. Now, let's start with Ford. Ford is a legacy automaker. It's heavily traded, and the stock tends to move pretty slow. Because of that, the implied volatility is super low. Let me walk you through the trades and show you step by step right on the screen. Let's jump right in. So as always, first we're going to take a look at the 52-week chart because we just want to become familiar with where the stock has been trading for the past year. So as we can see with Ford, it kind of chops around as all stocks do, and it's been kind of on a steady climb since around April, as you can see here. Now the stock is currently trading at $13.32 per share. Let's take a look at the options chain. Now this video is posting on Thursday. So if we sold a Friday put, there's not much value to that. So let's take a look at December 26th, which is next Friday. Now keep in mind, the value of these contracts are going to be less than what they typically would be otherwise because of the Christmas holiday. So when we're selling a put, we're committing to buy 100 shares at the strike price if the stock drops below that price. So let's start with looking at a $13 contract because the price is $13.32 right now. Now, as we can see, this is only trading at $5 and the volatility is only 22%. So let's take a look at the rate of return and see if it's a good deal or not. Now, if we're making $5 and we're putting up 1,300, that means our rate of return is about 0.3%. And this is about a 1-week contract. So if we annualize that rate of return out, we multiply times 52 weeks, and we get a rate of return per year of about 20%. It's not that high. Let's go out a little further. Let's look at January 2nd because of the Christmas week next week. And let's look at the same $13 put and calculate that rate of return. So if we divide $13, which is our premium, into 1,300, which is the capital we need to make the trade, we're making about 1%, but we're holding the contract for about 2 weeks. So if we multiply times 26, we're still only making about 26% per year. And the reason I say only is because typically when you're trading, you probably want to target a higher rate of return, at least 50%. That way, you have some flexibility in case a trade goes against you. I also took a look, just out of curiosity, at a 6-month contract, let's say June of 2026. Now, if you were to trade a $13 put, it's pretty close to the money because right now the stock is trading at $13.32, and as we can see, the delta is 41. Now, this contract last traded at 108, but the bid is 102. So let's use 102 as our premium, illustrating this example. So if we're making $102 and we're putting up 1,300, we're making about 7.8%, but that's for 6 months of time. So if we multiply that by 2 to get an annualized rate of return, we're making about 15% on our money, and we're selling a strike that's pretty close to the money. So even though Ford is a very well-known name and it's heavily traded, in my view, it's not really worth selling options on because your rate of return is pretty low. So you see, even though Ford might seem safe, when you pull up the option chain and do the math and look at the rate of return relative to the risk and the capital that you're putting up to make the trade, it just doesn't make sense. Now let's compare it to American Airlines. Now, airline stocks are historically pretty unprofitable, so I don't typically trade them myself, but I wanted to include it in this series because the stock is trading under $20, it has a lot of volume, and the implied volatility is still upwards of 30% or so. Let's take a look at the math on these trades. Okay, so let's take a look at American Airlines. Here is a 52-week chart of American Airlines, and we just want to see where the stock has been the past year. So we can see it went down pretty significantly, and then it's come up a bit, and it's kind of been trading in these ranges. And right now, American Airlines is trading at $15.61 per share. So let's take a look at the options chain for this stock. Again, we're not going to look at December 19th because there's only 1 day's worth of time left in that contract. So we're going to start with December 26th. Now, as an example, we can sell a $15 put, and we can see the delta is 23, and the implied volatility is 39, almost 40%, which is decent. Open interest is not bad at 1,300 contracts. So let's take a look at our rate of return. We're going to use the bid price for calculating our rate of return. So if we're taking in $11 in premium and we're putting up $1,500 in capital, we're making about 0.7% for about 1 week's time. So we're going to multiply by 52 to get our annualized rate of return. We can see that we're making about 38% per year, significantly better than Ford. Let's just take a look and go out a couple of weeks and look at January 2nd. So let's look at January 2nd and we'll look at the same $15 contract. Well, that bid is 20. So we're going to calculate $20 in premium divided by 1,500, the capital needed to make the trade. And we're making about 1.3% for about 2 weeks' time. So we'll multiply by 26, and that gives us an annualized rate of return of about 34%. Not bad, but again, I generally suggest to target at least a 50% annualized rate of return to make the risk worth your time. And the reason why these are falling a bit short is because they are bigger, well-known names with lower volatility. And volatility really matters when it comes to selling options, because the higher the volatility, the more premium you're getting paid. Something to definitely keep in mind. So what do you guys think? Do you see how important it is to calculate the rate of return before you sell a put? You want to make sure it's worth the capital that you're putting up. If this video helped, smash the like button, share it with a friend, drop a comment below, and let me know what your favorite ticker is. And as always, make sure you're subscribed. You don't want to miss a video. Thanks again, and happy trading.